Every mortgage quote you've ever been handed, every car loan you've been approved for, every credit card APR buried in 6-point type, every savings account paying you a rate that rounds down to nothing, every CD offer taped to the window of a bank branch. All of it traces back to one graph most people have never looked at, and almost nobody outside of finance can actually read. You already know the outline. The Federal Reserve sets interest rates. Rates go up, borrowing gets expensive. Rates come down, borrowing gets cheap. That's obvious. What's less obvious is that the Fed sets exactly one rate, an overnight rate, good for about 24 hours. And it has no direct control over the number on your mortgage. That number gets set by a market full of strangers placing a bet about the next 30 years. That bet has a shape. Plot the yield on US government debt against how long you have to wait to get your money back. 3 months, 2 years, 10 years, 30, and you get the yield curve. It is, quite literally, the price of time, what the market charges to be kept waiting. And once you can read its slope, the phrase interest rates went up is going to sound about as precise to you as the weather changed. You'll want to know which end moved and why, because the two ends are wired to completely different parts of your financial life. Start with the textbook version because it's clean and it's roughly 80% right. A 10-year Treasury yield is, in theory, just an average of what the market expects the overnight rate to be every day for the next 10 years, plus a little extra for the inconvenience. In ordinary times, that produces an upward slope. Longer wait, higher yield, nothing exotic, which means the curve can only invert. Short rates paying more than long rates. When the market has become convinced that the overnight rate will be dramatically lower in the future than it is right now, and there's really only one thing that makes a central bank cut that aggressively: an economy that has stopped growing. So an inverted curve is a forecast, translated into prices. Nobody is being pulled here. These people are paying. And the track record is uncomfortable for anyone who likes to think market signals are just noise. The spread between the 10-year and the 3-month Treasury has inverted ahead of essentially every US recession since 1955. With one clean false alarm in 1966. And that miss is worth a second, because it wasn't really a miss. In 1966, ceilings on what banks were legally allowed to pay depositors meant that when short rates rose above those ceilings, money simply walked out of the banking system entirely. Credit seized up. Growth stalled hard. The Fed reversed course fast enough that no official recession was ever declared. The signal fired. Someone hit the emergency brake in time. That is the single blemish on the record. No 40-variable model, no proprietary indicator, a subtraction problem. That's the version you'll find in every explainer. Here's the part they leave out, and it changes what the signal actually means. A long-term yield has a second component that has nothing to do with forecasting. Economists call it the term premium. The extra compensation investors demand purely for locking money up and accepting they might be wrong about the next decade. It isn't a prediction, it's a price for uncertainty, and it moves for reasons that have nothing to do with the American business cycle. Watch what happened in the mid-2000s. Between June 2004 and June 2006, the Fed raised its overnight rate from 1% to 5.25%, hiking at 17 straight meetings. Under the textbook model, long yields should have marched up with them. They barely moved. Alan Greenspan, testifying in early 2005, called it a conundrum, which is what a central banker says when he pulls the lever and the machine doesn't respond. Ben Bernanke, then a Fed governor, offered the explanation that stuck: a global savings glut. Exporting economies and oil producers were accumulating enormous surpluses and parking them in US treasuries. That's a wall of buyers who have no opinion whatsoever about American growth. They need safe dollars. Their demand pushed long yields down and flattened the term premium into the floor. So when the curve inverted in 2006, it was doing two things simultaneously: pricing in a slowdown and reflecting global demand for long bonds that had nothing to do with the US economy at all. Same shape on the chart, two entirely different engines underneath it. And then central banks started reshaping the curve on purpose. The Fed's balance sheet went from roughly $800 billion before the 2008 crisis to a peak near $9 trillion, and a large share of that was spent buying long-dated bonds specifically to force long yields down. which puts you in an odd position as a reader of the signal. You're taking a measurement from an instrument that the people you're measuring have been openly recalibrating. So if the signal is that contaminated, why does it keep working? Because the curve was never only a forecast. Consider a bank's business model at its simplest. It borrows short and lends long. Deposits, checking, savings, CDs are short-term liabilities that reprice quickly. Mortgages, auto loans, business term loans, the bond portfolio, long-term assets locked in at yesterday's rates. The bank's profit is the gap between those two numbers. That gap is the slope of the yield curve, converted into revenue. Flatten the curve and the gap compresses. Invert it and the core lending business runs upside down. The institution is paying more for money than it earns on loans it already made. It doesn't collapse, it just stops taking risk. Underwriting standards tighten. Marginal borrowers start hearing no. The small business that would have gotten a line of credit last year gets declined this year, and nothing about that business has changed. Only the slope did. This is the moment the curve stops being a status readout on the screen and reveals itself as an actual game mechanic. The inversion doesn't merely predict the slowdown, it participates in causing it by making the machinery that manufactures credit less willing to run. The forecast helps produce the outcome it's forecasting, and this is exactly where it reaches into your accounts. Your mortgage rate is not set by the Fed. 30-year fixed mortgages track the 10-year Treasury, the long end, plus a spread. Meanwhile, your savings account, your money market fund, your CDs, your credit card APR, your home equity line, most variable rate student and small business debt, all of that tracks the short end, where the Fed actually operates. Two ends of one curve, wired to two different halves of your balance sheet. Which is why, when the curve inverts, the money you save starts paying you well. At exactly the same time, the money you borrow long stays expensive. During the inversion that ran from mid-2022 into late 2024, short-term Treasury bills and CDs paid savers more than they had in roughly 15 years. While mortgage rates stayed stubbornly elevated because the long end never came down to meet them. People kept waiting for the Fed to fix mortgage rates. The Fed does not have that lever. The second half of that connection is less visible and hits harder. Because the slope determines how willing banks are to lend at all, it quietly sets the odds on decisions you experience as personal. Whether your refinance gets approved, whether the auto loan comes back at the advertised rate or 4 points above it, whether the business line of credit you've had renewed for 6 straight years suddenly comes with conditions. None of that shows up as a number in the news. It shows up as a slower response, a higher down payment requirement, a polite no from an underwriter who won't explain the reason. Because the reason isn't about you, it's about a spread. There's a genuine optimization available to anyone who understands this. When the short end pays more than the long end, cash stops being a penalty for indecision and becomes a position with a yield attached. And locking in long-term borrowing gets relatively cheaper, not more expensive, precisely when the headlines are loudest about high rates. Most people do the opposite because they're tracking one number called interest rates that doesn't exist. Now for the part that turns a market indicator into a scoreboard. Inversions don't hurt everyone. They redistribute. The losers are structural. Anyone whose debt reprices on the short end while their income doesn't. Anyone forced to refinance during the inversion rather than before it. And institutions that got the maturity mismatch wrong. Look at what Paul Volcker's tightening did in that respect. By June of 1981, the federal funds rate hit 20%, the prime rate had run past 21%, and mortgage rates climbed above 18%. Households were simply priced out. But the deeper damage landed on savings and loan institutions, holding long, low-rate mortgages funded by deposits that suddenly cost a fortune. The mismatch that detonated into the S&L crisis. The same physics ran again in March 2023. Silicon Valley Bank had loaded up on long-dated treasuries and mortgage bonds during the low-rate years, funded by deposits that repriced almost instantly when short rates rose. When it sold roughly $21 billion of those securities, it booked a $1.8 billion loss, and the run arrived within days. Nothing exotic, no toxic derivatives, government bonds, the boring stuff. The mismatch was the risk. The winners are quieter. Anyone with long-term fixed-rate debt locked in beforehand. Anyone with cash sitting at the short end while it was paying. Large corporations with direct access to bond markets who can choose their point on the curve instead of accepting whatever a lender offers. And notice the pattern. The winners almost always made their decisions years earlier when the slope looked boring and nobody was talking about it. Which brings us to the episode that embarrassed a lot of forecasters. The inversion that began in mid-2022 became the longest on record, roughly 2 years, and at points the deepest since the early 80s. Then it uninverted in late 2024, and the recession didn't arrive on the usual schedule. The mechanism didn't break. The wire it normally travels down had been cut. An unusually large share of American household debt was locked in at fixed rates set before the hikes, so higher short rates never reached most household budgets the way they historically would have. Large government deficits pushed in the opposite direction at the same time. The curve was describing real pressure on credit. Bank lending did slow, standards did tighten, but the pressure got absorbed before it reached the broader economy. And the reverse embarrassment is just as instructive. The curve inverted in 2019, and a recession did begin the following year. But it began because a pandemic shut down the global economy. The bond market did not know that was coming. Nobody did. The curve got credited for a call it could not possibly have made, which should tell you something about how these track records get assembled. A signal with a 1 to 2 year window and a real economic mechanism behind it will occasionally collect wins it didn't earn, alongside the ones it did. That's the honest version, and it's more useful than the mythology. The curve tells you the price of time and the pressure on credit. It does not tell you the date. Historically, the lag from inversion to recession has run anywhere from about 6 months to 2 years. A cool down long enough that people confidently declare the indicator dead right up until it isn't, and long enough that treating it as a timing device has cost people more money than ignoring it entirely. So step back and look at the whole map. The yield curve isn't a prediction published by an institution. It's thousands of participants, pension funds, foreign central banks, insurers, traders, quoting a price for time at every horizon at once, updated continuously, with real money behind every quote. Its slope simultaneously reflects what they expect, what they fear, and what they'll charge for the privilege of waiting. And that slope then feeds back into the banking system and changes who gets credit and who doesn't. Every meaningful financial decision you make is a bet on a specific point of that curve. Fixed versus adjustable is a bet on the long end against the short end. 15-year versus 30-year is buying a different point entirely. A CD ladder is a deliberate spread across several. Refinancing is switching rungs. Even your job can be attached to it. If you work in construction, autos, real estate, or lending, anything bought with financing rather than cash, your income is quietly tied to a slope you never agreed to. Most people make all of those decisions without ever seeing the shape they're making them inside of. If this kind of breakdown is what you're here for, taking a system everyone references and pulling out the mechanism underneath it, subscribe to 8-Bit Economics. No hype, no predictions, nobody telling you what the market does next quarter. Just the underlying code. If this changed how you think about interest rates, hit the like button and leave a comment telling me which end of the curve your own finances are actually attached to, because most people are surprised by the answer once they check. By the time everyone sees it coming, the smart play is already over. There's something strange about a market that will openly quote you the price of the future and then get politely ignored for years at a time. The curve isn't hiding anything. 2 numbers, publicly available, updated daily, and the subtraction takes a second. What makes it hard isn't the math. It's that the answer arrives long before the consequences do, and human beings are terrible at acting on information that won't be validated for 18 months. So the signal sits there in plain view, priced by people with money on the line, while everyone else waits for a headline to confirm it. Every rate you will ever be offered on a house, a car, a balance, a savings account is a quote on the same underlying thing. How long you're willing to wait and what somebody else will pay you for that patience. The curve is simply the market saying that price out loud. The question was never whether you're exposed to it, you already are. The only question is whether you can read the shape you're standing in.